The health and longevity landscape is an evergreen concept online in terms of content, between YouTube Shorts and Instagram Reels of fitness influencers to the wildly successful Don't Die system built by Brian Johnson. And in this landscape, one company has captured the attention of retail traders, and that company is HIMS and HERS. When I first heard about HIMS, my reaction was, okay, we're dealing with a bit of an online pharmacy model here. In the UK, you have things like Lloyd's Pharmacy or Lloyd's Online Doctor, and Superdrug. These websites allow you to have doctor consultations, fill prescription medication, and have subscriptions towards these medications. But when I looked at the HIMS website, something caught my eye. Let's have a look at the Lloyd's website. So here you'll see you have a pretty simple page. It shows your phone and it shows that you've got the online doctor there. You complete a questionnaire, it gets confirmed by a clinician, and you receive your treatment. Then they've also got their treatment area, which shows things like the weight loss, erectile dysfunction, contraceptive pill, STI, hair loss, and blood tests. And if we go to the Superdrug website, the first thing that you notice is it just looks like one big infomercial. You're bombarded by Trustpilot scores because that's apparently the most important thing. And then you've also got the coupon codes here, save 10. And if you go down, you've got their healthcare services with their top services being erectile dysfunction treatment, contraceptive pill, and weight loss treatment. They also separate between women's health and men's health. But now, let's go have a look at the HIMS website. So what do you notice about this one? Yeah, one of these clearly had a marketing budget. I mean, just look at that Viagra ad. Have great sex in bold with the word sex highlighted in Viagra blue just to keep it aesthetic. Meanwhile, back on the Superdrug one, we were going past those spammy Trustpilot scores and promo codes. And once you've scrolled past them, you arrive at erectile dysfunction treatment. I'm not going to lie, having great sex sounds like a much better pitch than premature ejaculation treatment. And it's no secret, in 2024, HIMS spent a whopping $678 million on marketing alone. That was almost half of the revenue it generated in that year just to get this nice website. And it worked. HIMS has been seeing massive subscriber growth as a result of this branding. Because that's it. At the core, it's about building the trust with the customers for using this platform over the other existing pharmacies. Their mission? Well, it's to make you, yes you, happy and healthy in a way that's achievable, whatever that means. So who pays us? Apparently people who got sick and tired of pills looking boring and average. I mean, where was the imagination? Pills have been just too simple. You know, when I look at a pill, I want to know that it's been well designed, is aesthetically pleasing and interesting to look at. Otherwise, I just don't want to take it. I mean, have a look at this here. And best of all, your Viagra comes in a mint form. I mean, this is no joke. Have a look here, nice little container. If we go over to the actual pill itself, it's literally got these speckled mints inside of it. I don't even know where to begin. I mean, this is the future. This is revolutionary. Why would you want to have a simple blue pill when you could actually have a mint chewy? Just genius. And here we are. You see, this is a fresh way to treat erectile dysfunction. We don't want an old way. We want a fresh way to do it. And I love here it even says longer lasting erections. What, longer than before? Now that it's mint? Who knows? And so really, we're not dealing with any new technological advancement in the pharmacy space. We're not dealing with any new innovations or achievements. We're just dealing with branding. But it's important. People want to trust the platform where they get their prescription medication, and they're clearly targeting the next generation, the younger generation. They're looking at the millennials, the Gen Zs, and beyond. Now, in my last video with Airbnb, I highlighted the importance of understanding the key internal business metrics above the share price, right? Making sure that the business metrics that we monitor are moving in the right direction rather than focusing on the share price. Now, the beauty about HIMS is the metrics are super simple. They have to grow their subscribers and they have to grow the revenue per subscriber, okay? How many people are buying on the platform, subscribing on the platform, and how much revenue are we generating per each subscriber? Now, HIMS is doing exactly that. At the end of Q3 for 2025, they had almost 2.5 million subscribers, up 21% over the past 12 months. And in addition, they've also grown the revenue per subscriber by 19% from $67 to $80. So what does it mean? More people are coming on to the HIMS website, subscribing, and more of them are spending more money each time. So if that's the business model, how does $1 become owner cash, right? If we invest in this company, how do we actually get a return on our investment? Now, for every $1 in revenue that HIMS generates, they have to pay the fulfillment costs. These are like the actual physical product, okay? Those sparkly pills, well, they aren't free. They actually cost some money to make. Then they have the packaging and then the costs of the home delivery. Pretty sure they still have to up their game on the home delivery because I want my delivery men to be wearing matching clothes for the pills I'm buying. But the cost of that actual fulfillment was about 21 cents for every dollar they generate. So very, very low. Then they had that 46 cents for every dollar that was spent on marketing. Well, we saw why. And then we also have 13 cents on sort of the back office and keeping the operation alive. Bottom line is they are cash flow positive. That's what we want to see, right? They are actually getting a free cash flow and the operations are generating cash for the business. So how does that cash actually flow through the business? So if we look here, I've taken the opening cash. We've got the operating cash that was generated by the business of 251 million. They had some investments that they sold, and then they had some share issues. They issued the shares, they got cash in exchange. For 2024, they had a total available cash of 438 million to spend. Great, let's see what they do with it. CapEx, nice and light, typical of these growing online businesses, right? 41 million in CapEx. They had an acquisition of Medisource RX. Basically, this is bringing in-house production capabilities for medication, okay? Instead of us paying somebody else to make the sparkly pill, we now can make the sparkly pill ourselves. They spent 11 million on the website development. So above marketing, they actually spent 11 million on website development. There is a nasty number, which is the 55 million in share-based compensation, and that is just the cash element, not the total expense to the business. And we will explore that later on. And then we finally got the share repurchases, which is actually the business buying back shares from investors. And ultimately, if we look at from revenue generation through to the cash flows and where they allocate that cash, that share repurchase line is the only place where an investor is getting some sort of return. So what about its moat? Well, it's no surprise that HIMS brings nothing new to the pharma game. Its single moat, as envisaged and executed by the founder and CEO, Andrew, is its brand. It's got sexy looking penis pills. Now that marketing builds trust with the target customers. And that trust builds habits. Right? This is a convenient way to get your prescription medication. They have also added on HIMS Labs, which is essentially a way just to do your blood work. That comes together to create a convenient place for the customer to monitor their health and longevity. But how does this moat die? Well, if the moat is trust, then the moat dies if that trust breaks. And they're playing in a game where you're dealing with a lot of regulation. Okay? If they offer something on that platform that later gets removed due to health and safety concerns, that is a catastrophe, because they would have to be very rigorous with their testing before allowing something on that platform to be sold. So as owners, our focal point in terms of moat would be, is the branding paying off? And are we ensuring that trust is maintained on the platform? So in section 2, we look at the capital discipline of HIMS. We're looking for evidence of them being good stewards of the capital, but we're also equally looking for red flags. Where are we worried about management quality and governance concerns? Well, if we look at evidence of discipline, we saw those share buybacks in the cash flow section, but here's the kicker. They aren't shrinking the share base, right? We want to see the number of shares issued coming down because that drives up the earnings per share. If that number isn't coming down, then the share buybacks aren't doing much. In fact, what they are doing is they're slightly offsetting the shares that are issued to the executives. That's all. But we are not shrinking the share base, which is what we want to see. Another aspect is that they've got no debt, right? This is a self-funded, cash flow positive engine. It's generating money. They can allocate that money as they see fit. Unfortunately, they're paying a lot of that to the CEO, but we'll get to that just now. And lastly, we have the acquisition, right? Buying an existing business that sits well within the key stack that they're offering, being able to develop those products in-house is a good use of capital. So what are the red flags? Now, I've got a few slides on this one. The first thing is the share-based compensation, right? That 92 million share-based compensation expense in 2024. And we saw that they spent 53 million of that in cash. That is massive. The next thing is the CEO pay. So just the CEO, right? There's an entire board and there are employees, but just the CEO pay. I've got an entire slide just for that section coming up. And then we've also got the CEO, Andrew. You've got his voting power. At over 90% of the votes, this is a one-man show, right? He says what goes. We don't have any say in this business. We also want to look at how aligned the incentives are of management with us as owners. In this case, they're partially aligned. Okay, revenue is the key KPI that they're monitoring, but they've got these large stock grants, right? Each time the sales reach a certain point, we get this absolute whoosh of stocks issued to the execs, and they get all this cash and money out of the business every time. Now I'm going to carry on with the red flags here because I'm not done. There are three things I want to cover here. Firstly, why is this Andrew guy tweeting about Palestinian protests? I mean, why is he even involving himself in that arena? I mean, if you look at this headline here in May of 24, HIMS and HERS loses 210 million in stock value after CEO says he is eager to hire anti-Israel protesters. Now, obviously, it's not what he said. He wanted to clarify it or update it. Regardless, the fact that he was tweeting about it in the first place. If I was an owner and that was my employee, why are you doing that? Secondly, our Andrew boy has got great timing when it comes to selling his stock of HIMS, right? He sold about 10.2 million in stock just last month. But here's the kicker. He sold at an average price of around $58 mark, okay? If we look at where the share price is today, oh, wait a minute. It's currently at $37. So that's 36% down from when he sold it. Talk about timing. And finally, because of his holding in HIMS and the value of HIMS, Andrew is now a billionaire. Got no problem with that. More power to him. But here's the thing, if we look at his compensation, in 2024 alone, Andrew was paid $24.6 million, okay? He had 570,000 of that as base salary, and he had 1.1 million of that as cash bonus, right? So over 1.6 million in cash, and the rest in stock awards, 22.7 million. Now, when we look at the size of the business and how much cash is left over, this is significant. This is CEO of Google territory, market caps of trillions of dollars. If that wasn't enough, there was something that I spotted that really just got under my skin. And it was this little footnote here, which was that 180,000 was paid for Mr. Dudham's home security system. So not only is this guy now a billionaire, not only did he get 1.5 million in cash, another 22.7 million in stock awards, but he also took 180,000 from the business to pay for his home security. I mean, why on earth would the owners have to pay for that? From my perspective, as a management behavior, this isn't a good thing. And so while I focused heavily on Andrew here, remember this is the individual who has over 90% of the voting power. He decides what's going on. So his behavior is what you want to watch as an owner of this company. Between his keyboard warrior antics and this absolutely skewed compensation package relative to the size of the business and this home security system, I don't get it. For me, those factors make it a tough pill to swallow. Let's get to section 3, which is the bottlenecks, right? What's stopping HIMS from doubling in size today? HIMS operates in an industry where its customers are ingesting things that it sells. So we're going to attract the likes of the Food and Drug Administration. And oddly enough, the current regulatory landscape has been favorable to HIMS. There have been loopholes that they've been able to exploit in the regulatory environment that's allowed them to sell GLP-1 products and fill a shortage that currently exists in the market. But here's the thing, those loopholes and that gap is going to end. At some point, they will no longer be able to generate the revenue they're generating from the GLP-1 offering. That GLP-1 is the weight loss drug. And so if the primary constraint at this point in time is around the regulatory environment, how can management work around this? Well, what they have to do is they have to lean on non-GLP-1 offerings for incremental growth, right? Remember, focus on the penis pills, focus on the hairy growth, focus on the other more accepted drugs that aren't subject to regulatory scrutiny, pushback, or even withdrawal. I mean, these things could eventually just be banned. And that brings us to section 4, which is where we ask, what is the lie that investors are telling themselves when it comes to the HIMS and HERS stock? And I was surprised to find that a lot of retail traders are talking about HIMS as the, quote, Amazon of healthcare. Now, if you've watched my previous video last week on Airbnb, it suffered from the exact same behavioral bias. There they were touting it as the Amazon of travel. And in this instance, they're calling it the Amazon of healthcare. Really? At that point, I just say, why not go buy Amazon shares? And I wanted to illustrate that here. We've got a Redditor posting again, it's the Amazon of healthcare. And that was 2 years ago. We've got AI articles that then generate news about companies, and it's generating articles about HIMS and HERS as Amazon of healthcare. I wonder if it just picked it up from that Reddit post. And then I thought I found a silver lining. There was an individual who tweeted about it and said here, as much as it's popular on FinTwit to diagnose businesses as the next Amazon, so he's acknowledging that it's very common for individuals to call a company the Amazon of blank, he then proceeds to say, yeah, it's the Amazon of healthcare. So he acknowledges the bias and then continues to fall for it. And so this is what we call a narrative fallacy, right? This is where the story is greater than the math. The story here being Amazon of healthcare, which is widely amplified online. So how do we mitigate that as potential investors of HIMS? Well, no Amazon language allowed, right? Strip the business down into its segments. We've got the hair, we've got the sexual health, we've got the GLP-1 treatment. Break it down into those segments, analyze the growth, analyze the trajectories. Do not talk about it being the Amazon of healthcare. That demands a premium, which is what we'll get to in the next section. And so now that we've analyzed the business, its capital discipline, its scaling bottlenecks, and the behavioral biases that surround the stock, we now arrive at our verdict, right? Is this something we want to own, watch, or avoid? Well, we saw it's a self-funding cash engine, right? No reliance on debt, it's cash flow positive, and they're able to invest that into that flashy website, to great marketing, and continue building the next part, which is their moat, and that brand and trust, that convenience that they provide to their customers, and further embellishing themselves in the habits of people's lives. We also looked at management behavior, and in particular the governance concerns and behavior around the CEO, Andrew. There are red flags there, they're tangible, and they're things to watch out for. We looked at the fact that HIMS is currently exploiting a regulatory loophole to maximize revenue, a loophole they acknowledge will close, they just don't know when. And lastly, we looked at the behavioral bias and the fact that there's this Amazon of healthcare narrative fallacy surrounding the company. So that puts HIMS as a watch. Okay, the fact that they're growing the business, that it's cash flow positive, that there's no debt, does mean it's a business worth respecting, but it doesn't mean it's a business worth jumping into. So if the fact that it's self-funding is a positive, what are the things we want to see before we say, yeah, risk on, this is something we want to build a position in? Well, firstly, we want to see continued subscriber growth, especially in the non-GLP-1 offerings. We need to see that incremental growth outside of the regulatory loophole that exists at the moment. Otherwise, it's just a short-term revenue bump. We need to see improved management behavior. The share-based compensation as a percentage of revenue needs to drastically come down, and there needs to be improved behavior from the CEO, Andrew. The regulatory landscape, we need to see loopholes close and things become codified so that we have that certainty on the revenue growth projections, especially around that GLP-1 offering. And then last, we need to see the narrative fallacy fall away, okay? It's currently trading as if it were a software company, despite the fact that it produces actual physical goods. And lastly, now that we've looked at the business, we've looked at the capital discipline of management, we've looked at the scaling bottlenecks, and we've looked at the behavioral biases, in this section, right at the very end, we look at price. Price is giving us an indication as to what the market believes about HIMS. What is the market telling us about the business at this stage? Well, it's very simple. It is aligned in the fact that they are rewarding the growth. HIMS is seeing fantastic growth in subscribers and revenue per subscriber. And also the market is volatile around the stock price given the regulatory friction concern around the GLP-1 offering. This is a very real regulatory risk. Only once those loopholes have been closed and that landscape becomes more certain will that volatility reduce. And where is the market out of alignment? Well, there is that Amazon of healthcare narrative fallacy that implies frictionless growth, that they can just scale up across the globe, but the reality is there are regulatory constraints and the competitors, and that needs careful consideration. They are pricing it as if it is a software company, not counting on the fact that if HIMS were to double today, they would need to increase headcount, logistics, warehousing, all of that would need to increase, and those costs will increase in line with revenue. There isn't this margin expansion that comes on a one-for-one basis. And then lastly, the market is underweighting the governance risk concerns. They seem to sort of shrug off the CEO's behavior and the red flags we've outlined before. And there we have it. That brings us to the end of our analysis of HIMS and HERS. It's an interesting company to look at. For me, the biggest lesson was how impactful branding is. They're not offering anything new. They're not offering anything different. They aren't making any technological or pharmaceutical enhancements or improvements or innovations. It's purely branding. And that alone was enough to make this Andrew guy a billionaire. I hope you enjoyed the video, and I look forward to seeing you in the next episode.